Guys, in this video, I am going to show you one of the best locations in Myrtle Beach, South Carolina, commercial properties for sale. We're strategically located right a block and a half from the SkyWheel, right up from the Myrtle Beach Boardwalk and Promenade, right up from the Country Music Festival, where 40,000 people come for about 3 days to some of the biggest names in country music. Yes, I'm also going to show you how private equity real estate deals can be structured through waterfall structures. I'm going to break down general partners and limited partners and who's putting capital in and who's managing the property, and the multiple tiers of distribution that can be set up and structured in a private equity real estate deal. Additionally, I'm going to show you the actual financial statements from 2025. I'm going to show you the historical performance on this property in 2024 and 2023. You're going to see all that information. I'm also going to take a walk right down to where the SkyWheel is, where Ocean Boulevard is, and the boardwalk, just to show you how close. I could literally almost throw a rock over there. It's that close. This deal, in my opinion, is one of the best deals in our market because of the future potential on this property. In other words, if it wasn't about the money, I'd still buy this place, because you can develop this property 5 years from now, 7 years from now, 10 years from now. This is one of those kinds of properties that can immediately start making you money now. And if you decide to tear it down and build a 50-unit boutique hotel, you could do it. And because the location is phenomenal, you've got a sure winner, in my opinion. Now, hit that like button, hit that subscribe button, drop me some comments. I don't want to hold us up. Let's get into this video now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential, and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better, because I'm aiming to give you a 10 times return on your time for watching my videos until the end. Now guys, as you can see, I'm standing just outside of 310th, only a block and a half from the SkyWheel. This is a parking lot here, and Ripley's, believe it or not, is just there, right there at Ocean Boulevard. Now, every once in a while, a property comes along and it has so much potential, future potential, to generate not only returns now, immediately, day one when you start taking it over, it's cash flowing and generating a profit, but also returns in the future at the next phase of development of the city of Myrtle Beach. Now, as you can clearly see, I'm going to speak to that for a moment. That's Ocean Boulevard right there. Now, that's all built out. That's most likely not going to change too much. I mean, it will change some, but this right here, this second row from Ocean Boulevard, from the beach, This is the next phase of development in the city of Myrtle Beach. So not only does this commercial deal, this 29-unit boutique hotel behind me at 310th, not only does it have the potential to generate immediate returns now, over the course of the next 5 years, if we hold it for 5 years, but it also has the potential to be destroyed and developed into possibly a 75-unit, 100-unit, 150-unit hotel. I mean, that's what I'm after. I'm after properties that have an exponential potential, that not only we can generate immediate returns now, but also generate returns into the future because they're in the very best locations in the markets where I invest. So all that being said, I believe that 310th is that property. It's one of those best of the best properties that you can find in the Myrtle Beach market that has the ability to generate not only returns right now, but because of its strategic location, right by the SkyWheel, right here, right next to Ocean Boulevard, you're going to be able to generate returns through future development projects right here at this same property. That's why I'm taking the time to break down what's called a waterfall structure so that you can better understand private equity real estate deals. Let's get to it. Now on this video, I'm going to break down a waterfall structure. And for those of you that don't know what a waterfall structure is, it is simply it's a spreadsheet that's going to track the distribution of cash flows between a general partner and or limited partners. It's typically seen in private equity deals. And ultimately, it's not going to generate any extra cash. It's not a way to make more money. It's simply, hey, how do we structure this deal so that everyone wins and wins well, so that everyone wants to keep playing? So I'm going to break that down for you. But before I get to the waterfall structure, I've got to break down for you the pro forma on this deal so that way you can kind of just see how the cash flows flow out over that 5-year period and how we arrived at the cash flows in the waterfall structure. Let's get to it. Now, while I'm diving into the pro forma, I'm going to walk to Ocean Boulevard to show you again how close it is. Now, the gross rental income, I've got you at $691,506 for year one. Let me digress. Let me explain. I'm going to walk you through the actual statements that I received from the listing agent on this commercial property, show you where the property is currently, what it's making on its most recent profit and loss statement that I have access to, and then show you some of the historical performance over 2024, 2023, and 2022. Let's dive into the 2025 profit and loss statement. Now, as you can see on your screen, that's the 2025 profit and loss statement. Guys, I'm not going to go through the whole thing. You can pause the video and look and see what all the different expenses are. What I want you to see is that the total income in 2025 was $464,000 and some change. After all the expenses, the net operating income was $340,000. I think that's $709.43. All right, here's what's going on. The current ownership of this property, they switched business models and they started going after long-term rentals. From what I understand, the sellers come from a background in long-term rentals. They played a little bit with the short-term rental game in 2023, which, by the way, was the best year that this property had, making over $700,000. I'm going to go over those numbers with you in a minute. But basically, you know, they changed the model and the business stopped producing so well. It's making shy of $500,000 a year when it was making over $700,000 a year. So let's dive into the 2024 and 2023 and 2022 statements. Now, I get calls, emails, and texts all the time from investors just like you looking to make an investment in Myrtle Beach oceanfront condos or commercial properties in our market. If that's you and you need a savvy investor to run financial analysis, to generate profit and loss statements, that has the research and has, you know, hard factual data that backs up how these condos have rented. If you need proof, I can get it for you. No matter where you are in the journey though, don't be a stranger. We've got lots of stories. Lots of investors call off of YouTube, email, text me. I work with all kinds of people from all over the world, guys. I want their story to be your story. So pick up the phone, give me a call, get over your fear, stop being afraid. The season's almost over. You can't waste any more time. Stop watching videos and pick up the phone and take action, because it can be a life-changing decision to make contact with me and open a new chapter of your life. 843-360-1737. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties, because of the strong rental demand from a growing population. The city's population grew by over 20% just in the last decade, with a significant portion of new residents moving here due to the low cost of living, warm climate, and access to beach amenities. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially in multifamily properties, because of the tourism-driven economy. Tourism accounts for over 25% of the region's economy. The demand from tourism-related workers ensures a steady flow of renters in multifamily units year-round. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties, because of the affordable property prices and high cap rates. With an average cap rate for multifamily properties being typically around 7 to 8%, our market is higher than national averages for coastal areas, offering strong rental yield potential. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties, because of the potential for value-add investments. Many properties near the coast have strong locations but may be underperforming due to outdated facilities or lack of amenities. Renovating these properties can create significant upside for potential investors. Now, the first picture that you're seeing on your screen here, that's the actual 2024 statement. It does not have a subtotal on it, so now I'm gonna blend in my actual spreadsheet on it. I basically took all those numbers and subbed them up. I summed them to give you the gross rental income for 2024. You can see there the annual was $161.97 for the average daily rate. The occupancy was 56%, and then the total in 2024 was $674,641.17. Now, in 2023, you can see the actual numbers I got there on the screen from the listing agent. But if you go to, or if you just look down at the very, very bottom there, you see that for the year, they made $764,367. So what's the deal? They switched. In 2023, they did short-term vacation rentals. They rented this boutique hotel, which is only a block and a half from the SkyWheel and the Myrtle Beach Promenade, the Boardwalk and Promenade, Ripley's, Landmark, Pier 14, the plot of land where the country music festival is. I mean, like, the location on this property is phenomenal. More on that later. I'm going to show you a map on the screen and kind of show you where everything's laid out. But the point is, they were doing short-term vacation rentals for people that don't want to rent oceanfront condo resorts. And apparently, there's a pretty strong market for it. So they're renting the property in 2023 on Airbnb, VRBO, and Booking.com, and most likely various other short-term vacation rental or online travel agency websites. Now, they made a ton of money doing it, but it's not their game and it's not their business. They do long-term rentals. That's their background. They toyed with it. It worked well. Then they started shifting to renting to month-to-month renters and more longer-term renters instead of these short-term vacationers. And they didn't make so much money. As you can see, in 2024, they made $674, and then even in this previous year, they made $464. So obviously, they are not doing as well as they once did when they did short-term vacation rentals. Now, let's dive into short-term vacation rentals at a boutique hotel. How does that work? Obviously, there's a market, a segment of people that are not interested in all of the resort amenities so much, and they just want a place that's super close to the beach. It's got one pool. 310th has one pool. It's not some massive, great pool, doesn't have a lazy river, doesn't have all the other on-site amenities, but there's a segment of the market that just wants that. And they they are willing to be more, in my opinion, more of a budget vacationer in our market, as opposed to people that will pay a premium to be in an oceanfront condo. So it's the same business as Myrtle Beach oceanfront condos, short-term vacation rentals. It's just a block and a half from the beach, and it's budget friendly, budget conscious vacationers. So that's why there's such a discrepancy in the financial statements on this building. And the market is the same market, it's just a different niche or a different segment of the short-term vacation rental market. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because our market has been the fastest growing market out of the 150 most populated markets for the past 3 years. Over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry, because of the 20 to 22 million tourists that visit our market each year, which is the number 2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors including families, snowbirds, and golfers. Now, back to the pro forma. Again, gross rental income. Year one, I've got you at $691,506. Basically, I'm saying that you won't do as well as they did in 2023, but you also won't do as poorly as they did in 2025, because this pro forma is based off of short-term vacation rentals, primarily running the boutique hotel for those short-term rentals. Now, I've got other income on there at $184,500. That is 5,000 square foot of commercial space in this building that is currently not finished and not used, rented out at $3 a square foot. And for anybody that knows the comps on commercial retail space in Myrtle Beach, I mean, you're at least at $16 a square foot. Like that's what current retail space is renting for. So it's a very modest number on your screen there for the year, $184,500. Now that gives you a potential gross income of $876,006. If you factor in some vacancy, you've got $17,520, leaving you with an effective gross rental income of $858,486,000. Now, we've got to factor in some operating expenses. You got property taxes at $40,000. By the way, let me just stop real quick. Check that out. That leads to the parking lot back behind Ripley's. That also is across the street from 310th. You've got all of the arcade and the Gay Dolphin and all of these places here. It's a prime spot, guys. Now, operating expenses. Property taxes were $40,517.94. Other operating expenses came up to $184,465.36. I went back in and changed one thing on the profit and loss statement. I added in a 10% of gross rental income property management fee to this pro forma, because honestly, the property management numbers were low to me. They were like $13,900 something dollars. Very well could have just been 3% on Airbnb. I got to look at that and see if that is what it is. I mean, and they very well could have just been using Airbnb as their quote unquote property manager. They've got a cleaner on site, you know, and they got a handyman if they need to get something fixed. So you might not need a property manager to the tune of 10% of the gross rental income. I factored one in. Generally on commercial properties like this, you would have a property manager, but they were able to do this for around $14,000 in property management fees. Again, I think that's simply online travel agency fees. All right, other operating expenses, $184, $465, $36. Put a management fee in here of $30,047. I've got a reserve fee of $43,379, bringing you total operating expenses to the tune of $298,409. Now, if you have $858,486 and you subtract out the total operating expenses of $298,409, you are left with a net operating income on this property of $560,76. Now, we've got annual debt service. You got to pay for financing. That for the year is $239,509. If you take that from the $560 that you got a net operating income, yes, you do have an equity cash flow of $320,567. Now, in my original pro forma, when I modeled this out in the first video, which you can click your screen for a link to it and watch the full layout there, I basically had the commercial space at $1 per square foot, which is really just way, way too low. So I increased it to $3 per square foot, and I added in a 10% of the gross rental income property management fee, which accounts for that equity cash flow change. I think it was $271 in the other video. Now it's gone up to about $320,000. Now, all in all, that's a cash on cash return of almost 21%. Now, let's dive into that waterfall structure and see how those cash flows are distributed. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories. Now, guys, as we're getting into that waterfall structure, I do want to point out real quick that there are volleyball courts here just across the street, and then back in front of me, technically, which I'm going to turn around in just a minute so you can see it, this is the massive field where the Country Music Festival takes place. Check this out. Talk about location, right? This is crowded and filled with people. I mean, I think it's over 40,000 people come for the 3 days. Where are those people going to stay? And are there budget-friendly travelers that don't want to stay in the oceanfront or resorts that would be thrilled to stay at 310? Absolutely. All right, guys, now let's break down that waterfall structure. In the pro forma slide on your screen, you can see that there was equity cash flow in the deal after annual debt service to the tune of $320,000 and some change just in year one. Now, at the top of your screen, you've got years 1 through 5. Those are those equity cash flows that are left over after all of the operating, after gross rental income comes in, all of the operating expenses are expensed, annual debt service is paid. That's the cash flow that's left over. That does not include taxes. Everybody's taxes are different, so I've not included that here. I can do that for you if you need somebody to run those numbers. But, all right, you got $320,567 in the first year, and then year 2, year 3, 4, and 5. Now, the capital structure. We've got equity to the tune of $1,540,023. That's the equity that's going to be required to get into this deal. It does include your down payment on the loan. Your LP, which is your limited partner and generally the investor, there's only one on this deal according to how I've modeled it. There could be 2, there could be 3, there could be more. I've got one just for simplicity's sake, investor on this deal, $1,386,020. Now they're putting in 90%, as you can see there, of the capital needed, of the equity needed in this deal. Then you've got a general partner or a sponsor. They're putting in 10% of the capital needed in this deal. They're putting in $154,002, while your LP or your investor's putting in $1,386,020. Now, we're going to get into the internal rate of return and the equity multiple in just a minute, but you can see them there on how all this fleshes out. Now, there's two different distributions that happen in a waterfall structure. I mean, two distributions that are modeled here for the purpose of operating cash flow and net sale proceeds. Technically, there could be other capital events that take place, like maybe you're going to refinance the property. There could be all kinds of different things that take place. But for simplicity's sake, we're just going to address two of them. The distribution of operating cash flow, that's the cash flows that are coming in during the holding period that the commercial property is owned and operated. All right, it's operating cash flow. Now, I've set this up with a tier 1 distribution of preferred return. That's at a rate of 9%. So what I'm saying is, for the LP and for the GP, their capital investment, the first thing that's going to be paid out is going to be a 9% return on their money before anything else is paid out. And then in tier 2, there's going to be a return of capital. In other words, the cash flows coming in each year are going to first be divvied up. It's called pari passu, which means essentially pro rata. The cash flows are going to be divvied up 90% to the limited partner, 10% to the general partner. The first thing that those cash flows are going to go towards is paying a 9% return on the money. The second thing that those cash flows are going to go towards is a return of capital. Now let's look a little bit closer at how that works. Now we have a capital account here, and the purpose of the capital account is tracking what is being paid, when and how, what's coming in, what's going out throughout the entire deal. You've got year 1. I'm going to go over the first year with you now. So in your capital account, you've got a beginning balance. That beginning balance is the total equity on the deal, $1,540,023. Now, there's a 9% preferred return that's got to be paid on that amount. That is $138,602. But you have operating cash flows to the tune of $320,567. Now, in this instance, because there's more operating cash flow than preferred return promised, there's no unpaid preferred return for that year. Now, you've got preferred return distributed, and that's that $138,602, because that's what we said we would pay a 9% preferred return for use of the capital in the deal. Now, there's a column there for cumulative unpaid preferred return. Well, we don't have any of that because it's only year 1 and everything was paid, so there's no balance there. Then you finally have a return of contribution, and that's $181,965. Ultimately, that is the $320,567 of operating cash flow, and then you're going to take out that preferred return that was paid. You're going to be left with a return of contribution of $181,965. Ultimately, that's part of the investor's equity being paid back to them. So in year 1, according to these cash flows, the investors would get $181,965 paid back to them of their initial contribution, in addition to the 9% preferred return. Now, the ending balance at the end of year 1 is $1,358,057. Now, what that is that's that $181,965 subtract the beginning balance of the capital that they put into the deal of $1,540,023. Now, that ending balance is going to be the beginning balance in year 2. And you're basically going to repeat this process from years 2 through 5 so that we can keep track of how much preferred or return has been paid, if there is any unpaid preferred or return that needs to be paid, and then what's the cumulative amount of preferred return that needs to be paid, and then finally how much return of contribution have we paid to investors back on their initial funds that they put into the deal, and finally what the ending balance there is. So if you look in year 5, basically everything based on these cash flows on this deal, by year 5 the investors have gotten paid back $299,662. It's that simple and that easy. And you might be thinking, well, what happens to that $300,000? Well, you're just about to find out in the next tier, but let's keep going. Now, in year 1, how is the money that's been paid divvied up? Well, out of that $138,602 of preferred return, 90% of it went to the limited partner, and then 10% of it went to the general partner. Now, real quick, it's probably important to let you know that the general partner generally has their hands on the day-to-day operations of the deal. They're the manager of it, and the limited partner has a back seat in the sense that they just put the capital up. That's generally how it plays out. And so then you have tier 2 distributions there. So the first tier, that was of the operating cash flows on preferred return. Those tier 2 distributions are just going to be based on return of contribution, return of the capital invested in the deal. So you can see out of that $181,965 in tier 1 that was a return on contribution, the limited partner got 90% of it, $163,769. The general partner got 10% of it, $18,197. And then that final the final table there is the distribution of operating cash flow. And ultimately, that is going to be both tier 1 and tier 2 cash flows combined for the total amount of operating cash flow that was distributed in this portion of the deal over that 5-year holding period. So you can see in each year, if essentially if the limited partner got $124,742 of the operating cash flow for preferred return, and he got $163,769 in cash flow for a return on contribution, then he had a total in year 1 of $288,511, and of course that general partner got $13,860 in tier 1 of those operating cash flows for his preferred return on his investment. Then he got back another $18,197 for his return on contribution, finally giving him a total distribution of $32,057. Now that's how cash flow, operating cash flows during the holding period for a commercial property through a private equity deal structure could be structured and could be handled. Now, let's move on to net sale proceeds. That's the next big capital event that's covered in this waterfall structure. Now, in this section, we have to handle initial contribution and any unpaid preferred or returns. So that's handled right up front. But this happens at the sale of the building in year 5. So the net sale proceeds after the mortgage was paid off was $2,432,561. Now, that capital account balance we talked about earlier, that $300,000, that $299,662, that's the remaining balance in the 5th year of the money that the investors put up in the deal that still has yet to be returned to them. So that's got to be paid back. So you'll see there, tier 1 cash flow, that's the total. 90% of it's going to the LP, 10% of it's going to the general partner. And then finally, if you take that $299,662 from the net sale proceeds, guess what? You're left with cash flow available for tier 2 to the tune of $2,132,899. Now, tier 2 is the continuation of those net sale proceeds. So at this point, you'll notice that there is what's called a promote. And what that means is essentially in this deal, if the general partner has done a great job, he would get a 20% promote, moving him from that 10% stake in the deal to a 30% stake in the deal because he's done such a good job managing this property and it's performed so well. And ultimately, that's what's been agreed upon in the contracts and the legal language. Now, let's map that out. Tier 2 net sale proceeds. Year 1, we've got cash flow available. We've got cash flow available for tier 2. That's $2,132,899. Then in tier 2 net sale proceeds, we're going to break that up 70% to the limited partner, 30% to the general partner. We've got 1.493 going to the limited partner and 639,870 going to the general partner. So what's the total distribution of net sale proceeds from this event, from the sale of the property? All right, well, the limited partner received $299,662 in tier 1. Then in tier 2, they received another 1.49329. So finally, that gives you right there a distribution of net sale proceeds total of $1,762,725. And then finally, your general partner received $29,966 in tier 1 net sale proceeds. They got a 30% promote in tier 2, so they got $639,870 for a total of $669,836. Now, that total cash flow there at the bottom is going to be a combination of the operating cash flow that was paid out during all 5 of the holding periods, plus the cash flows that were paid out upon the sale of the property, basically your net sale proceeds. So it's the total cash returned to each person throughout the entire deal at both events. So your LP, he initially put in $1,386,020. Year 1 got back $288,511. Year 2, $307,11. Year 3, $313,170. Year 4, $325,892. Year 5, $2,101,607 for a 25.5% internal rate of return and an equity multiple to the tune of 2.4. Come on, who wouldn't like 2.4 times the money they put in the deal? Then you got your general partner. He put in $154,002. Year 1 got that $32,057. Year 2, $33,412. Year 3, $34,797. Year 4, $36,210. Finally, in year 5, because he got that promote, he got $707,490. That gave him a 48.2% internal rate of return and an equity multiple to the tune of 5.48. You might be asking, guys, why in the world would he get so much? Why would his IRR and his equity multiple be so much higher? He put less capital in the deal and he got the promote, ultimately. Now, the IRR could be looked at how the deal performs for you. Ultimately, it's the rate of that or return, of course, factoring in time. So the point is, guys, here that this is how a larger deal could be structured that possibly a few oceanfront condo investors might want to invest in. They might want to pool their resources together. You could have 3 limited partners in this deal. You could have 2. You could have 5. It just depends. Maybe a group of golfers want to come down, have a place at the beach, and also be able to make some great money. There's many ways to set up waterfall structures so that larger deals like $4 million boutique hotels in a phenomenal location in our market can get financed. You can make excellent money and then possibly roll it in 5, 6, 7 years up the road, roll it into another deal right here at this strategic location, because the location is what you are buying here. It's an excellent, in my opinion, it is the next wave of development in Myrtle Beach location. It's one of those opportunities that you really, really don't want to miss. So all in all, waterfall structures, if you got a few buddies, you got a few friends, it's totally a doable thing. Yes, always have a CPA look over your stuff. Yes, always consult an attorney. Yes, I have provided this information for educational purposes. If you are interested in in private equity deals, you want to learn more about waterfall structures and how these deals come together, pick up the phone and give me a call. It's 843-360-1737. I have provided this information to the public for educational purposes. I want you to be educated on how to knock out bigger deals in your life. I don't want you to get stuck only having to do oceanfront condos if you've got bigger dreams and if you've got a strong sphere of influence and a network around you or other investors that you'd like to partner with on deals. Perhaps you like to play golf, and you want to get some buddies together to come down here, and you want to own a commercial property that you can be invested in for 10, 15, or 20 years. Maybe you own this, it makes you some money, and then you tear it down and build a larger one. I mean, there's all kinds of ways to roll this thing. And that's what makes this location, in my opinion, priceless. It's phenomenal. You just got to have the know-how. You got to be savvy. You got to dice that deal up just right. But right back behind me is a diamond in the rough. Now, real quick, guys, I want you to check this map out on your screen. As you can see, 310th is the giant yellow arrow on your screen. Now, you can see where the ocean is, plain as day. You're literally right next to the ocean. You can see where Ripley's is on your screen. You can see where the SkyWheel is on your screen. And to me, that's the big one, the SkyWheel and the Boardwalk. When people think about Myrtle Beach, in their mind, they think about the SkyWheel and the Boardwalk. When investors think about investing here, they always think, I want to be near the Boardwalk. The Bayview, the 3-bedroom, 2 bathrooms that are not remodeled, that are ugly, are making right at $100,000 a year. With carpet, they're dated and they're ugly. I have investors that buy at Bayview all the time because the returns are there, because it's located on the Boardwalk. And to be honest with you, the type of person that rents that unit is not so much families. It is retirees, it is fishermen, it is snowbirds, it is singles, it is couples. It's people that necessarily would not be interested in all of the on-site amenities at the oceanfront resorts. And it's right here, just down from the SkyWheel, the same crowd renting this place. Now, Pilar Park, you can see there. You can see the Myrtle Beach Boardwalk and Promenade. You can see Pier 14. And of course, another big one is that massive field where the Country Music Festival takes place. So this location, in my opinion, is, it is besides the cash in this deal, the location's why you buy this property. Because this location can be turned into future cash flows. It's someone that's got a long-term vision that sees the value in something like this and goes, dude, we could put multifamily apartments here. We could put a hotel here. Of course, pending zoning and approvals and all those kinds of things. But the location is prime. And that's what you want to invest in when you buy real estate. Now, I get calls, emails, and texts all the time from investors just like you, looking to make an investment in Myrtle Beach oceanfront condos or commercial properties in our market. If that's you and you need a savvy investor to run financial analysis, to generate profit and loss statements, that has the research and has, hard factual data that backs up how these condos have rented. If you need proof, I can get it for you. No matter where you are in the journey though, don't be a stranger. We've got lots of stories. Lots of investors call off of YouTube, email, text me. I work with all kinds of people from all over the world, guys. I want their story to be your story. So pick up the phone, give me a call, get over your fear, stop being afraid. The season's almost over. You can't waste any more time. Stop watching videos and pick up the phone and take action, because it can be a life-changing decision to make contact with me and open a new chapter of your life. 843-360-1737.